Greetings, investors. My name is Gene Melamud. Welcome to Investor's Edge. I'm with the Bel Air Private Wealth Management Group, and I'm here with my esteemed colleague.
I'm Hunter Burnett. Nice to see you all today.
And so today's format is a little bit different. We're going to try to impart a lot of information to you. So our format will be as a conversation that we have about what our customers do this time of year. But this is also a time of year where our call volume from customers about 1099s really picks up, right? Because right now we're getting calls from customers, and within the next 3 or 4 weeks we're going to be getting calls from CPAs. Where is my 1099? What is this item? What is that item? And so forth. And so the common question that we get today is, all right, did I get my 1099? Am I ready to go to the CPA? What's the rush? And so that's what we ask a customer, like, why are you in such a rush to go see your CPA as soon as you get your first 1099? Is it because you're getting a big refund?
If you're getting a big refund, you should ask yourself a couple questions why. I know most people always believe having more money in your pocket is a great thing. However, if you're getting a big refund, reasons may include that you paid the IRS too much and they're not paying any interest on the money that you overpaid them. You earn more than a bank, honestly, at that point. That's one of the biggest items that we see. Also, maybe you're not withholding enough on your taxes.
Or withholding too much, right?
Or too much, yeah.
So ideally, at the end of the day, what do we want to see from a customer? We want to see them owe a little bit, right?
That's right.
Okay, so that's at the end of that's a good conversation to have with your tax professional. So when you get a first 1099, is that it? You're done? You can go to your tax professional and work on filing? Is there a chance for you to get an amended 1099? When, Hunter, why don't you elaborate a little bit and tell us when you would get an amended 1099?
Well, amended 1099s come out if there were capital gain distributions made by a fund that you owed and they had to true up their numbers at the end of the year and had to end up paying a little more in capital gains.
All right, so what Hunter is talking about is an actively managed fund where there is a money manager that buys and sells securities in this fund, and your share of the capital gain at the end of the year may be recalculated and may change. These are very, very large pools of money. And the capital gain calculation is going to be somewhat fluid, right? So if you went to your CPA early with the first set of 1099s, and lo and behold, first week of March, you wound up getting another set of amended 1099. What happens?
You're going to have to go back, most likely pay your CPA a little more money to file your amended tax returns.
An amended return. Not fun. So don't rush to your CPA. We've had numerous conversations with customers, and our customers know that trying to visit with your CPA second or third week of March is reasonable. If you are going to go there and hand off your documents early, please ask them not to file, not to push the go button and file your 1040 automatically. That's what most people do early.
Right.
So in preparation, at the end of last year, what were some of the things that we were talking to customers about in preparation for this season, right? So, you want to go through a couple?
First and foremost, tax loss harvesting. Quite honestly, every single client is most likely going to have a tax loss harvest conversation. Another option may be, hey, have you made your contributions to your retirement accounts in time? That could be something that a deduction could be made in before taxes are filed in April.
So we actually got an email from one of the CPAs that we work with, and the email was, okay, we have several mutual customers, and he pointed out these customers' names, and he said, I would like for you guys, with customers' permission, to send us a report that summarizes their capital gains and dividends and interest. And then, of course, we catch up with the customer, get their authorization, send this report to the CPA, and then the CPA would in turn use that report and have additional conversation with the client about anything unusual that may have happened that year. Because if they didn't pay enough in withholdings, if they didn't pay enough in estimated payments on quarterly basis, when is the last time you can true up? January. January is the last time you can true up. April, you owe unless you filed for an extension. So do you do that? I mean, at the end of the year, do you work with your financial advisor to get this information to ultimately provide to your CPA as a year-end call and tell them anything unusual that may have happened during the year so that you're not shocked with the outcome of April 15th or in case you file an extension in October? So the next thing is, let's talk about, folks, a standard deduction versus itemized deduction, right? Most folks who are retired use standard deductions, right? Unfortunately, some folks that have high medical costs, unfortunately, some folks who are ill and pay more than, for example, 7.5% of their adjusted gross income, they may be eligible for itemizing, which may save them some tax money. Isn't that a great conversation to have with your accountant? You know, here's a list of all my medical expenses. Am I eligible to itemize, or should I still continue to use a standard deduction?
It's a must conversation, especially if you have those high costs.
I agree. And so what happens if your medical deductions and medical costs are high, chances are your income is on the low end. And what do we talk about with customers when the income is on the low end and they have some flexibility with their retirement accounts? What are some of the things that we say? We can take an extra distribution from their retirement account because it's taxed at a lower rate, right? Or we can talk about converting part of your traditional IRA to a Roth, right? You're in the lower tax bracket. Why not take advantage, if your medical costs are high, to get these retirement assets down a little bit so that ultimately, when you pass this asset on to your heirs, a non-spouse beneficiary would have to liquidate this asset in 10 years, right? So if you can get it down in your lifetime and the costs are not prohibitive, for example, you're itemizing your deductions and your income is low, why not talk about that? And so in the event your income is high, you know, what do we chat? What kind of conversation are we having?
We might be looking at a qualified charitable distribution if your income's too high. What that means is you go ahead and take out the income that you can donate to a charity of your cause choice, and you can write that off as non-taxable income.
So what he's referring to, right, is a qualified 501c3 organization. And your accountant will be able to confirm, right? You can't donate, you can't make a distribution from your retirement because you have a good heart and you want to help your family member. You're going to have to make it to a qualified organization like a church or a temple or any religious outfit that might be, or anything that's close to your heart for medical research or whatever it is. I'm not going to go through it. It just has to be an accepted 501c3 organization, and if you're thinking about doing that and you're concerned, then your accountant could always verify. At the end of the day, having that conversation with an accountant is important. Why? Because they signed your tax return.
That's right.
At the end of the day, if you think you made a qualified charitable distribution to a charity that you think is charity, but it isn't, your accountant isn't going to sign off on your return because you might have a problem. So these are the kinds of conversations that I think are good. And so you're still working, you're a business owner, right? If you're a business owner, then you want to first of all keep your finances separate, right? You don't want to commingle your personal money with business money.
It's another headache.
All right, so then you want to provide your accountant with a pretty good audit trail of what all you spent your money on, so that they can give you an itemized deduction list of what's eligible and what isn't. And then, I think probably most importantly, that kind of gets lost in the shuffle, are you taking full advantage of retirement contributions towards your retirement accounts? And so this question is going to go on through April for last year. And so just as a reminder for our viewers, the 23 contribution to an IRA, assuming your income isn't too high and you're not phased out, what is it?
$6,500, and if you're over the age of 50, it's up to $7,500 for that additional $1,000 for the year 2023.
And now that we're in February of 24, can we make IRA contributions for 24?
Up until April 15th, you can. If you extend your tax filing, you cannot make a contribution with that extension for the prior calendar year of 2023 for retirement accounts.
Beyond the April 15th deadline.
Correct.
All right. So for the IRA contribution of 24, we can contribute, what, $1,000 more? Is it $7,500?
It's a total of $7,000 if you're over the age of 50, up to $8,000.
Very nice, because there's a $1,000 catch-up. And what about the 401k?
401k, you can contribute up to $23,000, and you have a catch-up of up to $7,500 if you're over the age of 50.
How many people do we know that we have ongoing conversations where they say, well, I don't want to contribute to beyond a certain point to my retirement account because I'm not getting a match on it. And so
I can't tell you how many.
We get a lot of questions like that, right? So I think, and Hunter can elaborate, we remind investors that when you're making a tax-advantaged deferral, you're taking some of your wages and deferring them in a retirement account. Your immediate return before investment return is the taxes that you didn't pay on that money. It helps the compounding.
Exactly.
Right? So why would you only limit your contribution to whatever your match is? You ought to try to maximize your contribution, maximize your deferral, but don't stretch, right? Because when we see what happens to people that start and stop, they start a contribution and they stop.
It's awful. It's like timing the market. It just doesn't work out well.
That's precisely right, because you stop. When do you stop? At the worst possible time. When you should be a buyer, the market's down, you should be a buyer, and then you stop. Why? Because times are tough, you may be concerned about your position, you may be concerned about your business, and so you want to stop because you're stretching, or you want to repay your debt. Don't do it. The successful investor in a retirement plan, even if you lowball yourself a little bit, contributes the same dollar amount over and over again. And I emphasize it just because if you're doing it over and over again, in a normal market, like we have, today, we have elevated rates. If you're expecting for the market to just go straight up, I got news for you. In elevated interest rates, with all the stuff that's going on around us geopolitically, the market is likely to go up. We're up and down. We're likely to have at least 2-3 moves of 5% or more, up or down.
That's right.
And if you're contributing consistently into your retirement plan, you have an opportunity to catch that decline. Let me remind you, 23 was only a couple months ago. If you missed November and December of 23 with your investments, you've missed most of your returns, right? That's how short this window is. In an elevated interest rate environment, the window to make money is short.
Very short.
If you're timing, if you're chasing artificial intelligence, if you're chasing cryptocurrency, good luck. Consistent investing, tax advantage investing is something you ought to think about. Include your accountant in that conversation, because when the accountant does a projection for next year, when the accountant tells you what is a reasonable amount of money for you to defer, they would like to know, what is it that you're contributing for charitable purposes? How much are you taking from your retirement accounts? How much are you contributing to your retirement? Are you itemizing or are you using a standard deductions? And so include your financial advisor in the conversation. If you don't feel comfortable talking to your accountant about these things, our customers say, you know what, you give us so much information. Can you call my accountant and talk about that? That's what we do. Is it possible for an investor to buy into a fund, for the fund share price to go down, and the investor still gets a capital gain at the end of the year? A pretty good capital gain.
It's possible.
It's possible, right? Because especially actively managed funds are contractually bound to follow the prospectus.
Yeah.
They can only have so much money in their top holdings. So I don't have to go through the stocks that have been hot. You follow the news, you know what's going on. So if any one particular stock or group of stocks make up more than a certain percentage of the portfolio, actively managed portfolio is going to have to rebalance. If they rebalance, they're going to have to sell some of the stock that makes up a bigger portion of the portfolio. The cost basis that's used for the sale of that portion of the stock is not when you bought the fund, it's when the fund bought that security.
Yep.
So when we're talking about Microsoft, when we're talking about Lilly, when we're talking about Google, when we're talking about NVIDIA, everyone's talking about it, right? These stocks ran, and if you mistimed and you came in with a single investment, right? You didn't dollar cost average into investment. You came in with a single investment, your investment is down. Is there a good chance that a fund that holds those securities pays a capital gain distribution and you can experience an unrealized loss and owe taxes? The answer is yes. Is that the worst thing in the world, though? Is that really that terrible? Because when you received a capital gain, yes, you pay taxes on it. But what'd you do with it? If you didn't take the capital gain and you put it back in, what'd you get?
Just increase your cost basis.
You got more shares.
Yes.
And if you believe in these companies and you're a holder of those companies long term, your price is just likely to appreciate anyway, especially if you continue to average in and add more. But if you missed harvesting the loss in 23 and you still have a high cost basis investment in 24, I think it's a little early to talk about it. We normally like to have tax loss harvesting conversations in October.
Yep.
But if we were going to have a conversation today, oh geez, we missed this one. We missed it. So why not harvest it now and move it into an investment that's not a similar investment, right? Because if you take a loss on something and move it into something similar, you might be subject to a wash sale. You might not be allowed to take that loss, right? You can't buy something similar for 30 days after taking the loss. It seems so arbitrary, but IRS makes these kinds of rules, not us, right? So if you moved into something that fits your portfolio after consulting with your advisors, right? You can harvest the loss now that you missed last year. And as we go into the end of the year, part of our year-end procedure in October, November, Hunter actually created an awesome spreadsheet for our customers where we can get a pretty good estimate of capital gains at the end of the year. Right? And so that prompts a lot of calls from us to customers and saying, hey, your estimated capital gain is such and such. The losses that we've harvested this year are such and such. And you have an opportunity to offset more. And if it's appropriate for us to offset more, you'll tell us. Right. If it's not, because you're having a tough year in business and your itemized expenses are high, we'll have that conversation. At the end of the day, we have to stay nimble, right? We have to adjust to what's happening in your life. That's what we do. So anyway, I'm very passionate about this. So I hope you enjoyed our passion with us and the information that was shared with you. And we look forward to seeing you again. And so cheers, happy investing.
Take care.